Hello and welcome to Sprott Radio. I'm your host, Ed Coyne, Senior Managing Partner at Sprott. I'm pleased to welcome two of Sprott's very own, Paul Wong, Market Strategist, and Jake White, ETF Product Manager. Paul and Jake, thank you for joining me today on Sprott Radio.
Hi, Ed. Thank you for having us.
Pleasure to be here.
The most recent report that you two co-authored titled Top 10 Themes for 2025. And I thought it'd be fun today, really for our listeners to kind of unpack some of those themes and really walk through some of the key points that you both made in this report. And Paul, let's start with you. You talk a lot about the deglobalization and how that's impacting pretty much everything. But as it relates specifically to gold and silver, what role is that playing and how are people looking at gold and silver today as this deglobalization starts to happen?
Well, it's primarily through central bank action. So the current deglobalization kind of really started in earnest in 2018 with the first Trump trade wars with China. That was the initiation factor there. Then after COVID was another driver, the Russia-Ukraine war was probably the final straw or catalyst that really accelerated central bank buying. Prior to that, central banks were buying steady amounts, but right after the Russian-Ukraine war, they nearly tripled their gold buying rate. Since then, roughly about 2.4 times the rate prior to the Russia-Ukraine war. The starting factor was the seizure of Russian FX reserves, somewhere in the neighborhood of $600 billion, depending how you want to count. And that basically was the wake-up call for most central banks. So since then, they have been buying aggressively.
And that continues to support, I guess, both gold and silver. I mean, silver still is viewed in some circles as a monetary metal, but this will bring you into the conversation, Jake. Silver also is starting to get a personality as it relates to critical materials. Since we're on kind of gold and silver, talk about silver just for a second, how that's starting to evolve over time from an investor's point of view.
Yeah, silver is really evolving. It's got about half of its demand from monetary applications and then another half of it from industrial. And a lot of that is being driven by electrical or specifically solar panels as the world continues to evolve along the energy transition and grow its demand in solar panels. 2024 and 2023 were both landmark years in terms of the amount of silver that was deployed and the amount of solar that was actually added in capacity. Silver is obviously the most conductive metal in the world, and therefore it's really critical within these applications. And not only is the amount of capacity of solar panels increasing, so the amount that we're really deploying out in the world is increasing, but the technologies of solar panels are using more silver than previous technologies because it actually gets you a better yield of your end electricity. The amount of silver and the deficits are starting to grow year over year, and we continue to see that. And it's really eating in substantial amounts of above ground stock inventories of silver. So we think that silver's well positioned going forward from that front.
And, talking about deglobalization, I guess that goes kind of hand in hand with energy security. As you deglobalize, you're trying to really secure your resources. Is that also pushing silver forward? And I guess all critical materials, is that one of the primary drivers behind critical materials today?
I mean, when you think about the Russian-Ukraine war, it kind of woke up a lot of European countries specifically, but it had global ramifications where, they can't rely on countries like Russia for natural gas, as an example, and they really need to be energy self-sufficient, something that, for example, China is not. So a lot of these countries in the East and the West are increasing their emphasis on energy security. And what does that mean? You don't want to be relying on trade from other countries, so if you have nuclear power plants, there's some elements in the supply chain that you're going to have to be relying on other countries. But instead of the daily flows of, for example, of oil or nat gas, where you consistently need these flows, you can change that to be, okay, well, we have multiple years of uranium inventories. We can figure out where we're going to get that enrichment capacity, for example. So it really increases the need for nuclear energy specifically and, a lot of renewable energy.
Well, it seems like just diversity in general of more energy sources is paramount. Speaking of that, speaking of critical materials, there seems to be a bit of an attitude shift now that the Republicans are back in office at the White House. Paul, you talk a lot about potential rollbacks and what that might look like for things like solar and other metals. Can you go a little bit deeper into that and what you're seeing out there or what you're reading out there right now as it relates to these potential rollbacks?
Well, so far the rollbacks, I guess, have not been officially announced, though they have been indicated. Yeah, we're going to see a rollback in the $7,500 EV tax credit, spending for charging stations. We're going to see relaxed emissions and EPA controls on internal combustion engines, etc. The rollback will be interesting only because the way the RA was set up, most of the spending, the majority of, depending how you want to account for it, but roughly about 60% are in red states, and these programs create jobs, well-paying jobs, and they're vital for the economic growth in these areas. When it comes to rolling back, we'll see how what occurs, but it'll be challenging to roll back jobs and economic growth.
Jake, from your point of view, as you continue to do work in the critical materials space, what are some of the key themes or key materials out there? Can you talk about that a little bit? What are some of the kind of standout materials out there right now?
Yeah, I think there's a couple that immediately come to mind. Uranium is definitely a critical material for the generation of energy within nuclear power plants. And I think both Republican and Democratic administrations have been pro-nuclear in the past. And actually, funnily enough, it's been mostly Republican administrations in the past. The Biden, the last 4 years, they were definitely pro-nuclear with multiple funding initiatives and support for the sector. But that was kind of a departure from previous ways. So I think, with the new administration coming in, nuclear energy is likely to be well supported. And, if we're talking about repeals of specific funding, I think, nuclear energy is less likely for sure to be affected by such things. So uranium, definitely a critical material that's here to stay. You can really see that, 31 countries just at the last COP29 conference, pledged to triple nuclear energy by 2050. So we're talking about globally advancing commitments towards nuclear energy and a lot of additional support there. Another critical material that we're really seeing from that perspective is copper. Copper is kind of ubiquitous for anything you want to do in the new digital economy. It's second in conductivity to silver, but obviously much, much cheaper. So whenever you're transmitting energy, you're going to require a lot of copper. Specifically, a lot of the discussion has been about artificial intelligence and data centers of late, and all of that requires significant amount of copper, and we see that the demand from this source to increase significantly. Another thing is just the increasing electrification of the world globally, or its grid modernization. A lot of the grid needs to be replaced and updated, and that's going to require a lot more copper. Another touch point we can point to as well is, within China, a lot of people talk about China's weakened property market, but the amount that they're spending on copper, specifically, for example, on their grid, where the state grid in China is actually the single biggest purchaser of copper, it's actually net positive demand we're seeing out of China, despite a weakened real estate sector. And that's, from renewable energy to these grid upgrades. So I would say copper and uranium are definitely the standouts from that perspective.
Paul, let's go back to you for a second and talk about market volatility as a whole. Maybe walk us through some of the volatility we've seen in the general markets, but also in the critical material markets that we've seen of late.
In the general capital markets, volatility has been rising. Basically, there's been a lot of uncertainty that's coming in, brewing. Mainly because we know there's going to be aggressive policies coming from the new administration in the U.S. We know that it's going to be more aggressive in terms of spending, so that will affect debt and deficits. The bond market has been reflecting a lot of that volatility of late, especially through rising term premiums. Term premiums are it's the extra yield the bond market demands as compensation for risk on the longer end from monetary and fiscal policies. So that's been rising. And as you increase bond yields more from a term premium perspective rather than a growth perspective, that impacts market multiples especially. So there's a very narrow concentration of market in the Mag 7. Very high earnings, but high earnings multiples. So typically high yields impact multiples. That's why we're seeing the volatility. Also, the bond market, equity market correlations have gone positive. So you've lost bonds as a hedge against volatility in the equity market. part of the reason why gold is also looking attractive as well. But you are seeing a lack of hedges in the marketplace. So what a lot of market participants are doing is they're going out into the options market, and particularly the volatility market, the VIX options market. It gets a little complicated, but we've seen 2 or 3 volatility events already this year, within the last trailing year, where you have these bursts of volatility, and that's basically it's the market. Basic market function is unable to absorb that kind of level of volatility. Nothing's broken yet, but it's a sign that things are not particularly well in the volatility market. From an economic macro perspective, there's lots of sources of volatility. There's bullish factors. We have a massive generational tech boom led by AI. The new administration, tax cuts, deregulations, stimulus policies. We're seeing massive capital inflows to the U.S. Economic and business optimism is sky high. That's the positive side. So days, you'll see that days markets reflect that. And then the bearish side would be, again, back to the ballooning debt and deficits. We're going to be running a very hot fiscal policy for a while. The bond market is the first asset class to notice that. We have pending tariffs and trade wars, protectionism coming. With that, you'll have counter tariffs, countermeasures from other countries as well. How far does it escalate? How far does it go? Again, that's the unknown part that's market is starting to grapple with. We have sticky inflation, and chances are from some of the Davos address that Trump made, it sounds like there's probably going to be a confrontation with the U.S. Federal Reserve as well in terms of interest rate policies. And that will be destabilizing for capital markets. So lots of sources of volatility from a market perspective, from a economic perspective, from a trade, geopolitical. There's a lot of sources of volatility brewing. Again, it's very difficult to quantify and even rank from day to day.
I want to go back to something you just said, Paul, that I think is interesting. We have been saying this at Sprott for a while about gold at least complementing bonds and in some cases actually replacing bonds. Is that something you're seeing happening more and more, and partly also why gold continues to remain strong as we go into yet another year of positive returns? What's your thought on that?
Well, gold since 2000 has outperformed bonds, period. There was a slight correction in 2013 to 15 period, but that's over. And gold relative to the U.S. Treasury Index just making new highs. It continues to outperform. I'll probably write up in the next quarterly review how well gold has performed relative to bonds. Central banks, roughly on average, 60-70% of their reserve holdings are currencies and sovereign bonds, the majority being currencies. Again, as we head into a very volatile trade protectionist world, you can see most countries are starting the process of devaluing the currency ahead of the tariffs, devaluing it relative to the U.S. dollar to make up for the impact of tariffs. So you're in the process of developing a competitive currency devaluation. We're the early innings of that. Again, depends on how significant the trade and tariffs war occurs. But that is one of the most bullish indications for gold.
Well, it seems like from your seat and from your experience, even gold, continuing to kind of flirt with and hit new highs, it still looks very attractive, it sounds like.
From a fundamental perspective, yes. From a chart perspective, yes. From every measure I can think of, yes. Risk of something negative occurring from massive global trade wars and protectionism, that favors gold significantly.
And Jake, let's go back to you and to stick on the theme with volatility for a minute. Uranium seems to be struggling a little bit recently, even though the long-term trend seems to be really positive. Walk us through what's happening with uranium right now and your view longer term on how you think uranium is going to potentially play out over time.
I guess we'll start with 2024. The spot price of uranium was down about 20%. But I think it's really important to contextualize that. And, even though it was maybe disappointing a lot for investors, it's kind of off the back of a 90% price surge in 2023. So there has been some volatility for sure. And the way we kind of look at that is that it's really a healthy market consolidation. I mean, there was a very rapid price increase over a very short period of time. And when you look over the long term, just as you say, like we're firmly in bull market territory where uranium prices were depressed for a very long time. And now we're finally at levels that kind of incentivize junior miners and a lot of brownfield projects to come back online. And uranium miners were able to outperform that spot price. But it kind of depends on what you're looking at as well. So that's the spot price, but the long-term contracting prices, which is a much larger market where it's the market for which uranium miners and utilities are predominantly contracting on multi-year contracts, and those prices hit a 16-year high. So, and conversion and enrichment prices hit all-time highs in 2024. Even if you talk about the average price of uranium in 2023 versus 2024, it was higher in 2024. So, if you're looking at endpoint to endpoint, obviously, yes, there was a decrease, but there's a lot of periods for which, uranium is actually performing, fairly well. And you're seeing that it's a much more healthy operating environment for uranium miners. What kind of contributed to a lot of this volatility? Recently there was some Kazakhstan supply troubles for sure. After a 90% price surge, there was some physical uranium for selling, we think, that going into the end of the year. And this is kind of more of a temporary dislocation. We think that there was a lot of hot hedge fund money that entered the space when uranium was increasing significantly and has since exited. If you really bring this back to the fundamentals of the uranium market, everything's just gotten stronger. The uranium market is characterized by significant supply-demand deficit that's been having to be met by inventories for multiple years. And we don't think that there's any more inventories that are available to sell. So we think, 2025 is going to be set up for just a record year for nuclear energy generation, especially when you consider AI and data centers and they're pairing more and more so with nuclear energy. As we talked about energy security, China, for example, is increasingly constructing more and more nuclear reactors. And from a supply perspective, we had the U.S. pass the Prohibiting Russian Uranium Imports Act, and then Russia retaliate with an export ban. And this is on enriched uranium. There's a lot of supply uncertainty, and the amount of inventories that utilities are holding is not likely going to be able to decrease much further. So what we're really looking at, one of the most important metrics, is long-term contracting. We're hoping that, U.S. utilities, we would have thought that they would come into the market more forcefully over the past couple of years, but they really haven't. They have not been contracting at a rate that's sufficient to replace their uranium inventories in the future. And we think that with the return of that, you might be able to see stronger uranium prices.
The supply-demand imbalance for copper remains fairly strong. But recycling is something that is alive and well in copper. How important is copper to the overall supply-demand narrative? Is it increasing, decreasing? Does it really matter? What have you seen in your work? Jake, we'll start with you on this as it relates to recycling and copper. Any thoughts on that?
Copper, like you said, can be recycled multiple times. And historically, copper recycling, it's been in the, let's say, high teens. I think there's been some interesting studies, one by S&P Global, where they did a higher recycling environment and what that's going to look like for the supply-demand imbalance. We're relatively balanced right now, but in a small deficit. And the current thought is that it's going to be escalating deficits going forward, increasing in size, given the increasing demands with, stagnant to falling supplies, actually. So their analysis showed that recycling, even with it increasing, to all-time highs, it still strongly showed that there's going to be supply-demand imbalance, regardless of if there was hypothetically an increase in recycling. So recycling is going to be important going forward for sure, and we should definitely try to increase that. But I think at the end of the day, this problem of copper supply is extremely hard. Copper has been something that we've been mining for a very, very long time. And the largest producer in the world, in Chile, Codelco, actually produced its lowest copper production in, I think it was 25 years. So, these companies or state-owned organizations are really struggling to increase their copper production into this increased demand, whether that be from long lead times or lower ore grades, or we're having less discoveries more and more. So, and I think you can really see that there's an interesting stat. So there's treatment and refining charges where, the treatment and refining charges just fell 70% year over year. So what does that mean? Treatment charges are basically how much the smelter is going to get paid. And it has two factors. One, it's got how tight is the underlying supply of copper concentrate, and then how much smelting capacity is out there. So we definitely believe that China, has overcapacity within the smelting sector. So that's contributed to it. But there's significant shortage of copper concentrate given all of these mine disruptions. You can see that with over 70% decrease in their treatment charges. And then even more recently, copper kind of had a great start to the year, the first half of the year of 2024, but kind of fell into the second half of the year. And with that, copper inventories were increasing as it fell. But now copper inventories are coming back down. It's really, mitigating the amount of buffer that the industry has to substantiate and hold off any significant price increases.
Well, and let's shift gears now and talk about it from an investor's point of view. And we've covered copper, we've covered uranium, we've talked a fair amount about gold and silver. But ultimately, how do we make money off this? As an investor, how do we participate in this? Paul, from an allocation standpoint, as you look at a portfolio, how much is too much? How much is not enough? And how would you think about those four core metals? So gold, silver, copper, and uranium. How would you basket those? What insights could you give an investor who's looking to allocate to this space for the first time?
Well, if you're looking at the commodity themselves, from an allocation point of view, when your first consideration would be volatility, what is the historical volatility of these assets? Next would be correlation to your other assets in your portfolio. If you're running a multi-asset portfolio, you need to understand where the correlations are, where they're positive, negative, stable, unstable, etc., where they have hedging capabilities or not. Yeah, that's the basics of it. And then you have to figure out what allocations, and you have to figure out what your risk tolerance is, your volatility outlook and outcomes you want to generate. Return profile, sharps, that kind of stuff, and you work backwards from there.
Just from a gold standpoint, what would you say is something that makes sense in most portfolios without digging too deep to how much risk they have and so forth? Is there a kind of general bandwidth you would say makes sense for someone to allocate gold to their portfolio?
Well, currently right now, gold has a rough historical volatility, roughly around 15%. Bonds have half of that. But the problem is that bonds have been your major source of risk for the last 4 years. It is the primary source of risk for any multi-asset class. Historically, it was the safe haven asset. Today, it's no longer the case. It can and will likely get worse as inflation problems, trade wars, etc. If you get a clash between the White House and the Fed, you'll have more issues involved. So gold, to me, is probably the only really reliable liquid, there's an important factor, liquid asset class you can use against your riskier assets. It does not have a negative correlation, but it does have low correlation to most other asset classes, equities in particular, even to general commodities as well. It provides an inflation hedge. And also importantly, it is really driven by central banks, and they have their own unique set of reasons why they're buying. It provides a pretty reliable floor. There literally is a central put on gold, much like the old Fed put on the equity markets 10 years ago during the days of QE. We can see that gold has not suffered a drawdown more than 4 or 5% in quite a while. And every time you see a pullback, you see buying return, and it's not from investment sources. We don't have complete data, but the inference is it's coming from central banks and or sovereigns.
Let's shift gears back to critical materials. And Jake, for an investor who obviously is looking at gold as a way to offset some volatility, does critical materials play a potential different role in a portfolio? Is it more about seeking opportunity versus offsetting volatility? Or how would you have an investor look at, let's just say, copper and uranium as two ways to participate in a portfolio? How should they be thinking about that from your point of view?
Yeah, absolutely. I think you hit the nail on the head there where, gold may be that safe haven asset that's offsetting volatility, but, uranium and copper, you're really trying to capitalize on the opportunity. You're really trying to capitalize on these long-term trends and these supply-demand deficits that we think are going to propel both of those critical materials forward. Uranium is already probably in the early innings of its bull cycle. And, commodities kind of have much longer cycles than maybe some other asset classes. And so, when you're talking about these early innings, there was, a decade where commodities didn't do much in the 2010s, especially uranium and copper, where they kind of went and were underinvested in, and that's kind of helping create this supply shortage. But when investors are thinking about allocating towards these things, I definitely think it's something that you're trying to slot it into your allocation that's really trying to seek returns.
Well, and speaking of materials, I don't want to do a disservice to some of the other critical materials out there. So outside of copper and gold, is there anything else that investors should maybe be paying attention to or looking out for as we go forward?
In general terms, real assets. If we get in a situation where basically Trump forces interest rates lower, but despite what inflation says, I think Powell's term expires in May of 26. So it could happen by then or even before then. But if you force, U.S. monetary policy to have unnaturally low interest rates, real assets by definition will increase in value. And you may as well grab, any real asset that has a secular overriding drive, demand driver behind it, rather than, something that's, I think we made mention of, some of the, commodities that, related to the, the Chinese economy, iron ore, met coal. That's really driven by their property markets, which are behind, overbuilt and overvalued. It may or may not happen, but if it does, I think, obviously gold is a natural, silver's a natural. And then after that, it's a grab for real assets. Be prepared, I guess. Hope for the best, prepare for the worst.
Yeah, interesting. Well, Paul and Jake, thank you for carving out the time today. I thought the top 10 for 2025 themes was fantastic. And I encourage our listeners to check it out on our website, Sprott.com. Paul and Jake, thanks for taking the time today to speak to us on Sprott Radio.
Great. Thank you, Ed.
Thank you, Ed.
And thank you all for listening. Once again, my name's Ed Coyne, and thank you for listening to Sprott Radio.
This podcast is provided for information purposes only from sources believed to be reliable. However, Sprott does not warrant its completeness or accuracy. Any opinions and estimates constitute our judgment as of the date of this material and are subject to change without notice. Past performance is not indicative of future results. This communication is not intended as an offer or solicitation for the purchase or sale of any financial instrument. Any opinions and recommendations herein do not take into account individual client circumstances, objectives, or needs, and are not intended as recommendations of particular securities, financial instruments, or strategies. You must make your own independent decisions regarding any securities, financial instruments, or strategies mentioned or related to the information herein. This communication may not be redistributed or retransmitted in whole or in part, or in any form or manner without the express written consent of Sprott. Any unauthorized use or disclosure is prohibited. Receipt and review of this information constitutes your agreement not to redistribute or retransmit the contents and information contained in this communication without first obtaining express permission from an authorized officer of Sprott.